Alright, in today's lesson, what we're going to work on, we're going to go back to Chapter 1, and we're going to look at a couple of quick problems here. The first one I want to look at is looking at Exercise 1-8 using the accounting equation. So, we have to determine the missing amount from each of the separate situations given below. By now, you should know that the equation has to be in balance. What the company owns must equal what the company owes. So assets must equal liabilities plus owner's equity. So in the first one, A, we know what the liabilities are, and we know what equity is. What we're asked to solve for is assets. And so in this case, we just add the liabilities plus the equity, and we end up with $65,000 in total assets. Now keep in mind that you could be asked to solve problems that drill down into each of these elements. So you could be asked, based on seeing a list of assets, a list of liabilities, and some equity accounts, and you could be asked a very similar question. So it's important that you remember which accounts line up under each of these elements. B. In this problem, we're asked to solve for equity. So we know we have $100,000 in assets. We also know that there are $34,000 in liabilities. Equity ends up being the unknown. So since we know that liabilities plus equity has to equal $100,000, the difference between $100,000 and $34,000 ends up being $66,000. So the answer to B is $66,000. In C, we know that there are $154,000 in assets and $40,000 in equity, and we're asked to solve for liabilities. So $154,000 minus $40,000 equals $114,000. And so therefore you end up with the $114,000 plus $40,000 equals $154,000. Alright, next, I would like to work on preparing an income statement. On October 1st, Ebony Ernst organized Ernst Consulting. On October 3rd, the owner contributed $84,000 in assets in exchange for common stock to launch the business. On October 31st, the company's records show the following items and amounts. use this information to prepare an October income statement for the business. What you need to do in approaching a problem like this is sort the accounts. You must sort them by financial statement. So when you look at this list of accounts, the first thing you should see is that they're listed in order. So cash, accounts receivable, office supplies, land, office equipment, accounts payable, common stock, all of those accounts are balance sheet accounts. So for now, we're not interested in those. What we are interested in are the income statement accounts. And when we look over in the other column, we see that we have consulting revenues, rent expense, salaries expense, telephone expense, and miscellaneous expense. Those will be the accounts that we need to work with. So we set up a template for ourselves. You could do this on paper with pencil, or you can open up an Excel worksheet, or you can even use a table in Word. All of the statements have that 3-line header in common: the name of the company, the name of the statement, and the date or period for that particular statement. Income statement is a period statement. Therefore, we use for month ended, and in this case, it's October 31st. And we're going to use a simple single-step income statement. So we start to eliminate the accounts that we're not interested in to focus on the accounts we are interested in. We're going to plug in consulting revenues because that's our revenue amount, $14,000. And then we are going to enter in our expense account numbers. And we add up for total expenses. And we calculate our net income or net loss. In this case, we show net income of $2,110. The math is not very complicated. The real issue is being systematic and being organized, and remembering which accounts match with which elements. So remember what accounts match up with an asset, what accounts match up with liabilities, and what accounts match up with equity. Let's see if we can do another one. Prepare a statement of retained earnings. So we have the same company, same contribution. Looks about the same numbers that we had before. In this case, the statement of retained earnings, we're interested in the retained earnings balance. Since October 1st was the organization date, prior to October 1st, the company did not exist. So therefore, the retained earnings balance on October 1st was 0. Net income for the period, we pull from the income statement that we just prepared. The other item that influences or affects retained earnings is going to be cash dividends. So we have retained earnings balance on October 1st is 0. We add our net income that was previously calculated from the income statement, $2,110, and then we subtract out the dividends that are paid of $2,000, and our retained earnings balance on October 31st is $110 for this company. Again, notice the 3-line heading, company name, name of statement, and the statement of retained earnings is a period statement. So it says for month ended October 31st. Next, we prepare the balance sheet. And remember, we're doing this in order. We start with the income statement. We move to the statement of retained earnings. Now we're going to prepare the balance sheet. So we have the same information. This time we're going to be interested in the balance sheet accounts. So we have our assets, which includes cash of $11,360, accounts receivable, which equals $14,000, office supplies, $3,250, land, $46,000. Over on the liability side, well, first one more, office equipment, almost forgot about that, $18,000. Then we move over to liabilities. We have accounts payable for $8,500. There are no long-term liabilities. We have only the accounts payable, which is a current liability. On the asset side, land and office equipment could be classified as non-current assets. This is a balance sheet. We could have prepared a classified balance sheet, and in that case we would have recognized what were the current assets, what were the non-current assets. On the equity side, we have the $84,000 in common stock. That was the original contribution by the owner. And then we had retained earnings of $110. We add up our total assets, $92,610. If we've done this correctly, we should have the same for liabilities and equity. And so that is our simple balance sheet. Finally, preparing a statement of cash flows. Now the process here is very simple because there isn't a lot going on. So they give us some assumptions. They tell us to assume the following. A, the owner's initial investment consists of $38,000 in cash and $46,000 in land. The company's $18,000 equipment purchase is paid in cash. The accounts payable balance of $8,500 consists of the $3,250 in office supplies purchased and the $5,250 in employee salaries yet to be paid. The company's rent, telephone, and miscellaneous expenses are paid in cash. No cash has been collected on the $14,000 in consulting revenues. So the cash in this case, is coming from the owner, and that would be the $38,000 being contributed. This is considered a financing activity. The purchase of the equipment, which is being paid in cash, is a use of cash or a cash outflow, and it's an investing activity. C does not immediately impact cash because it's yet to be paid. D, the company's rent, telephone, and miscellaneous expenses were all paid in cash, so those will show up as uses of cash, and they will show up as uses of cash in the operating section. And recall from the textbook that you have 3 sections. You have the operating activities section, the investing activities section, and the financing section. So we set up our template. Again, notice the 3-line header, name of the company, name of the statement, and because the cash flow statement is a period statement, it states for the month ended October 31st. Now, recall that the balance sheet was for a specific date. It was as of October 31st. The other statements, the income statement, the statement of retained earnings, and now the statement of cash flows, are all period statements. So again, balance sheet is like a snapshot, a photograph, whereas these other 3 statements are more like a video, a movie. So, in putting this together, we need to know what the cash flows from operating activities were. So, did we receive any cash from customers? Well, the answer to that is no. Okay, so we show 0. Cash paid to employees. Well, the salaries hadn't been paid yet. Okay. So it shows up on the balance sheet as a payable. So we increased the payables account. The cash paid for rent. Cash paid for telephone expenses. These are all operating expenses, and they're all going to reduce the cash balance that we have on hand. Miscellaneous expenses. And we show that we used $6,640 in cash for operating activities. Now remember, where did we come up with the $1,750 cash paid to employees? C specifically says that the $5,250 in employee salaries was yet to be paid. But if you look back at the accounts, if you don't look back at the accounts, you could get yourself in trouble. Look at salaries expense. Salaries expense for the period was $7,000. So that means that a portion of it was paid in cash. Which portion? Well, it's $7,000 minus the $5,250 that remained as a salary payable. The difference was the $1,750 actually paid in cash. Investing activities. We had our office equipment purchase of $18,000. And so that was what we show for net cash used by investing activities. Again, so far, no cash has been received in the business per the statement of cash flows. That's going to show up in the cash flows from financing activities, where we received cash from the owner in exchange for common stock of $38,000. And then dividends were paid out of $2,000. And so our net cash provided by financing activities is $36,000. And so you're netting the cash provided by financing activities against the cash used for investing activities and the cash used by operating activities to come up with the cash balance on October 31st of $11,360. Now, in the presentation, what we will show is the net increase in cash. The cash balance at October 1st was 0 because the business did not exist prior to that date. And the cash balance at October 31st should match what the balance sheet account is showing. In this case, the balance sheet account is showing $11,360. We now know where that cash came from and what it was used for. So we've walked through a couple of problems here. We've looked at the use of the accounting equation. We've looked at preparing an income statement, preparing a statement of retained earnings, and preparing a balance sheet, and preparing a statement of cash flows. The last thing we'll look at is calculating return on assets. Again, this is a ratio. It's dependent on the relationships between the numbers that are reported in the financial statements. So the Swiss group reports net income of $40,000 for the current year. At the beginning of the year, Swiss group had $200,000 in assets. By the end of the year, assets had grown to $300,000. What is Swiss group's return on assets? Well, the return on assets is going to be a function of net income and average total assets. Calculating average total of assets, you would need to add the beginning and the ending balances of assets and divide by 2. So we know that our net income for the period, because it's a return, it says return on, we always know we're going to be dealing with some income-oriented calculation here. So we start off in the numerator with the $40,000 in net income. And then our average total assets, as I said before, is just the $200,000 plus the $300,000. We divide it by 2 to come up with the average, and it's $250,000. So that's what we plug into our equation. We run the calculation, and we get a return on assets of 16%. So what do we use return on assets for? Well, it's a way for us to evaluate management's ability to take assets and generate net income. So the return on assets is also called return on investment, or ROI. So ROE and ROI are sometimes used interchangeably. And again, what it tells you is how much did you get out of those assets? What were you able to do with those assets? So technically, if you were comparing two businesses that were identical, if one had a return of assets of 16% and the other had a return of assets of 10%, one might conclude that the firm that earned return on assets of 16% was run better than the firm that only earned a 10% return on assets. So it can be used in a comparative sense between firms. It can also be used to track performance of a firm over time. So one could set a goal and say our goal this year is to make 14% on return of assets. The actual result comes in at 16%. So it shows that we were 2% over our goal. Or we could have set it and said, well, we'd like to earn 20% return on assets. We came in at 16%, and we fell short of our goal by 4%. Again, it's subjective. Management and the marketplace are the ones that set the expectations. So what are the goals? So that wraps up Chapter 1 in terms of doing a couple of example problems. I'll do some for Chapter 2 and Chapter 3, and I will get those posted for you as well.